Hi there, should you overpay your mortgage or increase pension contributions? We explain the key financial and tax factors to consider.
Imagine you've just received a £10,000 bonus, or you finally freed up £500 a month. Do you clear that 5.6% mortgage, or do you lock it away in your pension? This is a dilemma we see constantly at Atlas Tax Advisors. Welcome, and today we're breaking down the math behind this trade-off for 2026. Right now, we are operating in a specific economic anomaly. With average UK mortgage rates settling at around 5.6%, the math has shifted compared to the lowly environment of the previous decade. You are looking at two very different benefits. Paying down debt guarantees you save that 5.6% in interest. Putting that money into a pension captures an immediate 20 to 40% upfront tax relief. Rather than giving generic tips, we are going to analyze the exact outcomes for different UK taxpayers based on current lending rules and tax bans. This decision pits the psychological security of owning your home outright against the tax-optimized compounding of the market. This chart shows the mortgage strategy. When you overpay, you take post-tax cash, money already taxed by the government, and put it straight into your mortgage principal. That gives you a guaranteed, tax-free return equal to your mortgage rate. Doing this consistently reduces your term and saves tens of thousands in interest. However, once that cash goes in, it becomes an illiquid asset, effectively trapped in the bricks of your property. Many homeowners rush to overpay their mortgages without checking the fine print, entirely unaware of the pen pay clauses sitting in their contracts. This matrix outlines how most lenders strictly cap penalty-free overpayments at 10% of your outstanding balance per year. If you breach that limit during a fixed wait period, you trigger early repayment charges. These penalties usually drop from 5% in year 1 down to 1% by the end of your term. Feel safe. Ignoring your lender's limits can trigger fees that significantly reduce the interest savings you were trying to achieve. Now let's examine the alternative, boosting your pension through personal contributions or salary sacrifice. This chart compares £1 of gross pay flowing directly into a pension versus the reduced bar of net pay. By using gross pay, you avoid income tax entirely, securing an instant mathematical top-up. The trade-off is access and volatility. Your money is locked away until age 55, rising to 57 in 2028, and its growth depends on stock market performance. Before you make any long-term decisions, you must look at your workplace benefits and utilize your employer match. An employer match represents a 100% instant return on your money. From a purely financial perspective, claiming free employer cash will always outperform saving 5.6% on your mortgage interest. For higher earners, the pension strategy becomes particularly valuable when we factor in the £100,000 trap. As this graph shows, when your income sits between £100,000 and £125,140, the government tapers away your personal allowance. This means the effective marginal tax rate on that specific portion of your income spikes to 60%. If you are caught in this bracket, routing that income into a pension yields an effective 60% return. When compared to a 5.6% mortgage saving, the pension provides a much higher immediate value. There is a secondary advantage here for earners around the £100,000 mark who have young children. Earning over £100,000 disqualifies you from tax-free childcare and 30 funded nursery hours. Making a pension contribution lowers your taxable income back below that line, fully restoring your access to those programs. This creates a double financial win. You secure high tax relief on the contribution itself, and you recover thousands of pounds in family benefits. We also have to look at the future of these accounts, specifically the legislative changes arriving in April 2027. From 2027 onwards, most unused pension funds and death benefits will be brought into the value of your taxable estate for inheritance tax purposes. This shift means holding large sums in a pension past 2027 is no longer a simple way to bypass inheritance tax. It now requires careful, proactive estate planning to protect what you leave behind. Pensions are useful wealth-building tools during your earning years, but they now carry significant tax risks during the inheritance phase that paid-off mortgages do not. Securing a 5.6% guaranteed return on a mortgage is a strong option, but tax relief almost always generates more long-term wealth, particularly as your income rises. This quadrant helps map out exactly who should take which action based on liquidity and tax benefits. Consider a basic rate taxpayer who is nearing retirement age. This profile may benefit most from overpaying their mortgage. For them, prioritizing the certainty of debt-free living heading into retirement often outweighs the risk of chasing higher market gains. Now look at a company director earning £110,000 with young children. This profile should prioritize their pension. Doing so avoids the 60% tax trap and restores family benefits, creating enough upside to justify the illiquidity trade-off. You must answer 3 specific questions before making your move. What is your tax band? What are your mortgage terms? And your life goals. Generic financial advice is risky because your optimal strategy relies entirely on understanding your specific tax position and your exact stage of life. The correct choice depends on your tax band, the penalty limits on your mortgage, and your personal risk tolerance. Please note, this video is for general educational guidance only and does not constitute personalized financial advice. You should always seek professional advice before acting. If you'd like to understand exactly how these rules apply to your wealth, contact us at Atlas Tax Advisors. You can call us on 07404-427-275 or email us at info@atlastax.co.uk. Don't forget to subscribe to the ATA channel for more definitive UK tax strategies. Thanks for watching. Complex tax scenarios require bespoke professional guidance to truly maximize your long-term wealth.